Hello guys, welcome to i-tutor Academy. In today's session, we will start with the scheduled banks in India. That is Unit 5, Subsection 6, MMPC-003. Scheduled banks are those banks that are included in the second schedule of the RBI Act 1934. These banks need to have paid up capital and reserves of not less than Rs 5 lakhs. These also need to maintain CRR balance with the RBI, and they can raise debt and loans from RBI at the bank rate. Scheduled commercial banks are further classified as public sector banks, State Bank of India and its associates, old and new private sector banks, and foreign banks. Next is public sector bank. PSBs are those banks in which more than 50% of shares are held by the government of India. These are the major type of banks in India. At present, there are 12 PSBs, namely SBI, Bank of Baroda, Bank of India, Punjab National Bank, Indian Overseas Bank, Punjab and Sindh Bank, Indian Bank, UCO Bank, Bank of Maharashtra, Central Bank of India, Canara Bank, and Union Bank of India. SBI and its associates. SBI is biggest commercial bank in the country with nearly 25% market share and has over 22,000 branches and 58 and 500 ATMs. SBI came into being on 1st July 1955 when the Government of India passed the State Bank of India Act 1955 by taking over assets and liabilities of Imperial Bank of India. Private sector bank. Private sector bank are those banks in which the majority of the stake is owned by private shareholders in India. Private sector banks are classified as old and new private sector banks. The private banks which were not nationalized are collectively known as the old private sector banks and include banks such as the Jammu and Kashmir Bank Limited, Lord Krishna Bank Limited, etc. And the foreign banks. Foreign banks are those banks which have headquarters in a different country but has branches in India. As of July 14, 2020, there are 46 foreign banks in India. Regional rural banks, that is RRBs. They were established in 1975 to develop the rural economy and creation of additional channel to the cooperative credit structure to enhance the reach of institutional credit for the rural and agricultural sector. Next is scheduled cooperative bank. Cooperative bank function on the concept of cooperative credit societies, wherein the members of the society join together to extend a loan to each other at a subsidized rate of interest. And Narasimham Committee on Banking Sector Reform. Government of India set up 2 expert committees under the chairmanship of M. Narasimham for restricting of banking sector, popularly known as Narasimham Committee 1 1991 and Narasimham Committee 2 1998. And next is structure of capital market. In the previous section, you have read about the money market, which provides short-term funds to investors for less than 1 year. However, business units and investors need funds for a longer duration, also for undertaking business expansion or technology upgrading, and in this regard, they approach the capital market. Capital market, that is markets, instruments, intermediaries, and regulator. Markets are divided into 2, primary and secondary, and regulator is Securities and Exchange Board of India. Structure of capital market in India. Capital markets are comprised of 2 markets, that is primary market and secondary market. The primary market is also known as the new issue market, that is NIM, where the issuer of the securities, that is shares and bonds, sell the new securities to the investors directly without any intermediaries. And the financial instruments, some of the major financial instruments used in capital market are discussed below. One is share. Shares, a share indicate a unit of ownership by the buyer of shares called a shareholder or holders of the company. A shareholder has ownership in the company and has voting right and shares the company profit or loss. Next is bonds. Bonds are issued by state and central government, companies and municipalities to raise money for a variety of projects and activities. They are debt instrument in which the entities borrow the funds for a defined period of time at a variable or fixed interest rate. Next is debentures. Debentures are also a type of debt instrument which is issued by companies for raising funds, but they are not secured by physical asset or collateral. Sensex, also known as sensitive index or S&P BSE Sensex index, is a benchmark index of Bombay Stock Exchange. It is the market weight stock of 30 companies. Gilt edge market. The gilt edge market refers to the market for a government and semi-government securities and is backed by the RBI. Government securities are called gilt edge means of the best quality because they are highly liquid and risk-free. Capital market intermediaries. There is a large number of intermediaries in the capital market, some of which are discussed below. Merchant banks. Merchant bankers are intermediaries between investors and the company. They act as advisor who advises the entrepreneur from the stage of the conception of the project till the production begins. Underwriters. When a company decided to go public to raise funds, all of its securities may be not fully subscribed by the public, so there is a need for someone who can subscribe to those securities. And the next is portfolio managers or portfolio management services, PMS, a professional who enters into a contact with the client to advise or direct or undertake investment decisions on behalf of the client. Portfolio managers are of two types: discretionary portfolio managers and non-discretionary portfolio managers. Next is stockbrokers. A stockbroker is an individual or firm which is an intermediary between an investors and a security exchange. The stockbroker trades in the stock exchange on the behalf of their client. Regulator of the capital market or SEBI. In India, the capital market is regulated by the Securities and Exchange Board of India, that is SEBI. SEBI was established in 1988 as a non-statutory body, but with the passing of SEBI Act 1992, it was accorded statutory power. The major objective of SEBI are to protect the interest of investors and development and regulation of stock exchange, to prevent deceitful malpractices and to regulate and develop a code of conduct for intermediaries such as brokers, underwriters, etc. And the summary of this unit is here. This unit has given you detailed information about the financial system. Initially, you read about the importance of financial system. We already discussed, whereby it brings the suppliers and the borrowers of fund in common platform. In the subsequent section, the importance, functions and instruments of the money market were discussed. One of the major component of money market is banks. In India, RBI is the apex bank and it formulate and regulate monetary policy. Monetary policy has two instruments, namely quantitative and qualitative. Quantitative instruments include various policy rates like CRR, repo and reverse repo rate, bank rate, etc., which aims at controlling the quantum of credit. Qualitative methods like moral suasion, direct action and others aim at directing the credit flow to particular sector or prohibit the credit flow. RBI uses both instruments, but quantitative methods are more visible and easy to administer. And the keywords are here, and there is self-assessment questions from this unit. Differentiate between money market and capital market. We already discussed both money market and capital market. And differentiate between shares and bonds. What are the major functions of RBI? Write about some of the instruments of the money market and write a note on SEBI. Okay, all this we discussed. Try to answer these questions. It will help you on your final exam. If you have any doubt, you can just comment it on our comment box, or you can contact our contact number. Thank you so much.
i-tutor ES presents Ignou MBA, complete syllabus coverage classes and individual semester base, subject coverage program for MBA students, online and flexible sessions. For more details, contact 62382 17885.